Ever pondered how the rise of short-term rentals has influenced housing affordability? Let's take a journey back in time to the emergence of short-term rentals, a phenomenon that has significantly reshaped the housing and travel industry. Platforms like Airbnb entered the scene, offering travelers a unique alternative to traditional hotels. These platforms offered a more home-like experience, often at lower prices, and consumers quickly embraced them. With the promise of comfortable stays in residential areas and at prices that often undercut hotels, the appeal was undeniable. But as with any innovation, there were those who saw beyond the initial consumer benefit. Investors began to realize the potential profitability of these platforms. They started buying up properties not for long-term leasing, but specifically for use as short-term rentals. This trend wasn't just confined to individual investors. Soon, even large-scale real estate companies were joining the fray, snapping up properties left, right, and center to convert them into short-term rental units. Our cities began to change. Areas once dominated by long-term residents saw an influx of transient visitors. This shift wasn't just physical but economical as well. Property prices in popular tourist destinations skyrocketed, fueled by the demand for short-term rental properties. And as these prices rose, the number of properties available for long-term rentals dwindled. But the ramifications of this trend were not immediately apparent. While travelers reveled in the affordability and convenience of short-term rentals, locals grappled with rising rents and a shrinking pool of available housing. This trend, initially hailed as a win for consumer choice and affordability, had inadvertently sparked a new challenge: housing affordability. As we've seen, the birth of short-term rentals marked a significant shift in the housing market, but what was the broader impact? Stay tuned as we delve deeper into this in the next segment. What happens when investors start buying up properties for short-term rentals? Let's dive into the impact this trend has had on the housing market and affordability. When investors begin to see dollar signs in the short-term rental market, they swoop in, snapping up properties left, right, and center. They are, after all, in the game to make a profit. But what does this mean for the average person looking for a home to rent or buy? Firstly, the increased demand from investors pushes up the prices of properties. This is a simple case of supply and demand. When more people are vying for the same piece of the pie, the price of that pie inevitably rises. This means that homes become less affordable for those who want to buy, particularly first-time buyers and those on lower incomes. Secondly, the availability of long-term rental properties decreases. When properties are bought up to be used as short-term rentals, they are taken off the long-term rental market. This reduction in supply can lead to higher rents, as potential tenants are forced to compete for fewer available properties. This has been seen in cities around the world, from New York to Florence, from Paris to Dallas. This trend is not just confined to large cities either. Smaller locations like Bozeman in Montana are feeling the pinch as well. With housing costs skyrocketing and short-term rentals on the rise, affordability is a real concern for the local residents. So what we're seeing is a situation where the rise of short-term rentals is contributing to an affordability crisis in the housing market. People looking for long-term rentals or hoping to buy a property are finding it increasingly difficult as prices rise and availability decreases. The transformation of homes into short-term rentals has certainly upset the balance of supply and demand in the housing market, but what about the financial risks involved? Are investors playing with fire when it comes to financing short-term rental properties? This question is more than just a rhetorical one. It's a serious concern that's been raised as investors increasingly use risky financing practices to acquire properties for short-term rentals. Let's take a closer look at these practices. As the demand for short-term rentals has grown, some investors have resorted to methods like mortgage fraud to secure properties. This involves misrepresenting information on mortgage applications, often by stating that the property will be owner-occupied when it's actually intended for short-term rental use. This is a dangerous game to play, as it's not only illegal but can also lead to severe financial consequences for the investor. Then we have DSCR loans, or debt service coverage ratio loans. These are a type of investment property loan where the lender evaluates the property's cash flow to determine if it can cover the loan payments. It's a popular choice among short-term rental investors because it allows them to secure financing based on the property's rental income potential. However, while DSCR loans may seem appealing, they come with their own set of risks. They often require a higher down payment, have higher interest rates, and if the property doesn't generate the expected income, the investor could find themselves in financial trouble. And what happens if there's an economic downturn? Well, short-term rentals are closely tied to the tourism industry, which is notoriously sensitive to economic shifts. If the economy takes a hit and tourism slows down, those high occupancy rates can quickly plummet. Investors relying on rental income to cover their loan payments could find themselves unable to meet their financial obligations, potentially leading to a wave of defaults. This is where the risk of a market crash comes into play. If a significant number of investors default on their loans, it could trigger a domino effect, leading to a crash in the short-term rental market. This could have far-reaching implications not just for investors, but for the broader housing market and economy as well. The risks are high and the bubble may well burst, but how have hotels and cities responded to this phenomenon? As we move into our next scene, we'll delve into the reactions and strategies of hotels and cities in the face of this short-term rental boom. As short-term rentals grew in popularity, they didn't go unnoticed by hotels or city officials. The hospitality industry, faced with a new competitor, had to adapt and evolve to stay in the game. Many hotels began to offer apartment-style accommodations, complete with kitchens and living areas, to compete with the home-like experience that platforms like Airbnb were offering. They realized that to draw in the modern traveler, they had to strike a balance between the comforts of home and the luxury of a hotel stay. Hotels weren't the only ones having to adjust their strategies. Cities around the globe were also grappling with the rise of short-term rentals. In many popular tourist destinations, local officials saw the negative impacts of the short-term rental boom. The noise, the parties, and the transformation of neighborhoods into tourist hotspots were causing disruptions, but the most significant concern was the impact on housing affordability. As investors snapped up properties to use as short-term rentals, less housing was available for long-term residents, driving up prices and making it harder for locals to find affordable homes. In response, as cities began to crack down on short-term rentals, implementing regulations and restrictions. New York City, for instance, enforced a law limiting short-term rentals, a move that led to the removal of thousands of Airbnb listings. The aim was to convert these properties back into long-term housing, a strategy that had previously seen success in Irvine, California, where a ban on short-term rentals resulted in a 3% decrease in long-term rents. But it's not just the big cities taking action. Smaller towns like Bozeman, Montana, are also feeling the impact of the short-term rental market and are considering similar bans to protect local housing and maintain the character of their communities. The response from cities and hotels has been swift and decisive, but what does the future hold for short-term rentals? With all these factors in play, what does the future hold for short-term rentals? Well, the landscape is shifting. Increased competition is on the horizon as other travel booking platforms are readying to launch their own short-term rental options. This could challenge the dominance of Airbnb and potentially drive down prices, offering a win for consumers but making the market less profitable for hosts. Meanwhile, cities worldwide continue to grapple with the impact of short-term rentals on housing affordability. Stricter regulations are being implemented, as seen in New York City and Irvine, California, and these may become more widespread. This could lead to a significant reduction in available listings and a pivot to long-term rentals. Consumer preferences are also evolving. The charm of a home-like experience may wane as fees and cleaning charges rise, and hotels enhance their offerings to compete. In the face of these challenges, it's likely that the short-term rental market will look very different in the years to come and may not be as profitable as in its heyday. Only time will tell what the future holds for short-term rentals, but one thing is clear: their impact on the housing market and affordability cannot be underestimated.